After managing to stem the tide of a steadily weakening shilling, the Central Bank of Kenya will now be expected to increasingly turn its attention on a banking sector that has previously been reluctant to respond to its monetary policy actions. Though last week's decision was mainly meant to prop up a weakening shilling and in the process contain the threat posed to the economy by rising inflation, partly on account of more expensive imports, consumers expect commercial banks to factor in the twin impacts of the move by the central bank and higher inflation when pricing their loans.
We are unlikely to see that type of correlation between his action and the interest rates in the banking, because interest rates in banking are not driven by consumption. They're not necessarily driven by transport, they're driven by investment.
Commercial banks have previously been slow to lower their lending rates even after the central bank had consistently lowered its base rate as it pursued an easing policy aimed at releasing more money into the productive sectors of the economy to stimulate economic growth. The industry has often cited the unpredictable nature in the movement of the rate of inflation for its reluctance to react to persistent prodding by its regulator.
Lending rates are a function of economic activity because it's derived demand from demand in investments.
We have seen the interest rates moving down from an average of 18 at the beginning of last year to an average of 14. And we are seeing this year we are now headed towards 13%.
Mwangi was speaking on the sidelines of Equity Bank's annual general meeting where shareholders endorsed a dividend payment of 80 cents per share and re-elected 4 directors whose terms had expired. For Citizen Business, I am Tony Timase.